for our dear students to give your view on the Union Budget 2023. Though Sandeep Sachdeva sir doesn't require any introduction, let me quickly take you through his various achievements. And those are Sandeep Sachdeva sir is a chartered accountant and an advocate and a founder partner of DServe Legal. Sir has also been enrolled as an advocate at Bar Council of Maharashtra and Goa. He is an All India ranker in CA and the University Gold Medalist. Sandeep sir has rich experience of around 2 decades in the field of taxation and various corporate laws. Before founding DServe Legal, Sandeep sir was the executive partner with Lakshmi Kumaran and Sridharan, attorneys, and was heading their Pune practice. He has also worked for about 2 years with EY Pune. Being a litigator, Sandeep sir has successfully argued the matters before the High Court and Tax Tribunal apart from representing before various tax authorities. Also, he was involved in various matters successfully litigated before the Supreme Court. He has successfully argued the matters before the Arbitration and Labour Law Tribunal as well. Over the years, Sir has managed large portfolio of the clients and advised them on issues related to tax laws and regulations, and also provided strategy roadmap or solution in respect of structuring, tax planning, and litigation. Clients rely on his business acumen and strategic approach to find winning end-to-end solutions within the complicated legal work. He has been involved in resolving issues in respect of various cross-border transactions and advising clients on optimizing tax structure. He has anchored various projects of GST implementation, due diligence, risk assessment, tax compliance, supply chain reviews, etc. He has played a critical role in various business structuring transactions, including joint ventures, mergers, acquisitions, etc. Sir has in-depth understanding in the field of automobile, e-commerce, agri-chemical engineering, information technology, banking and financial and pharma sector, and has been involved in providing solutions on recent tax controversies impacting these sectors. He has expertise in providing hand-holding support to the clients during complex tax investigation and litigation. Sir is a regular speaker at various forums like ICAI, CII, ESCOM, and Chamber of Commerce as well. We welcome you, sir, here at this session and request you to please give your views on the Union Budget 2023. Thank you, sir.
Thank you, ma'am. I think I'm really overwhelmed. I hope I'm audible clearly.
Yes, sir.
Ma'am, even Ketan sir has joined.
Oh, great.
Morning.
No, Mosmi, you continue. I will address later.
Okay, great, sir. Sandeep, sir, can we go ahead?
Yes. Thank you very much. I think now, without taking more time, we'll straight away come to the point. First of all, I would like to say that we all are students. Even I am a student. And I was just talking before the session that to understand anything better, should start speaking about it. I'll not say teaching about it because I still don't see myself in a shoe of a teacher. So we all will be learning together. The approach of this session would be that we'll take some fundamental points instead of getting into detailing, instead of seeing multiple things. We'll focus on few things and we'll try to understand in a conceptual way. Because once the concepts are clear, then it will be easy for us to navigate and multiply at a later stage. So I'll just share my screen. And please feel free to raise your hands wherever you have any questions to ask. We will take up the questions. Can somebody confirm whether my screen is visible?
Yes, sir, it is.
Okay. So now If I talk about the volume of changes in indirect tax in this budget, I'll say not much. The volumes are not, because generally what it used to be in indirect tax, the volume of budget, volume of changes, what it used to come. Because of monthly GST council meeting, things are really uh, in a period of 12 months. So every month there are some of the other changes, some of the other amendments which keep coming in, but there are some fundamental point which only the parliament can amend the law. Only those changes are coming in the budget. The rest of the changes, basically rates change, some exemption given, some exemption withdrawn, some rule and procedures. All those things are part of now a monthly feature. So, in fact, not much changes in this budget with respect to that has come, because that are part of the monthly bulletin. But what are the legislative changes in the CGST Act, IGST Act? All those changes have really come in this budget. So we'll spend some time on that. So in this, we'll cover what is the changes in GST, the changes in customs, some legacy issue, what are the changes which have already come. And in the last, we put up some 2-3 case laws, just to give you a sense what way the case laws are really coming. Before I get into GST, I just want to say that, like you, I also started a career as a CA. I've gone through all the trainings, absolutely not dummy, is a full-fledged training, which I went through. And later on, my inclination went into only on the interpretation side and not on the number side. But both are equally complementing to each other. So therefore, understanding the numbers, understanding the law. And if you are into business of tax, I will say we should understand 3 aspects: what law is, what numbers are, and what forms and procedures are. Because unless we know all 3, somebody may be stronger in one area, maybe weaker in other area. That is quite possible, because everybody cannot be 100% in all 3. But reasonable understanding of all 3 is very, very important if you really want to be a tax professional. If somebody says, no, I know only one, ये तो ऐसा होता है, but क्यों होता है? From where this is coming, where the power is coming? I think those sort of basic questions, which every tax professional should have it in their mind. Instead of getting into a template way of working, and this I am talking to more to a student, instead of growing yourself into a template way of working, my sincere and humble request to you is start questioning that from where this template is coming. And everything is written in a law. Everything is written in a law. In fact, what should be the font size? What should be the spacing in the line? What should be the margin in a page? That is also written. So therefore, one has to have a reasonable understanding of all 3. So today maybe we'll spend a little more time on the legal side, but maybe in some other discussion we'll spend some time on numbers as well as on. I'm not as great in numbers, but forms and process and procedure are the equally important aspect with respect to knowing the law. So what are the changes which have really come in GST? One is you know that there is a Schedule 3 in CGST Act, and Schedule 3 covers the transaction which are neither goods nor services. Now there are some amendment which came in 2019. 3 type of transactions, mainly third country sale. Third country sale mean out and out. I am in India, say I am Thermax in India. I have a customer, say in Nigeria, and to provide a service or to sell a goods to my customer in Nigeria, I need some turbine. and that turbine is manufactured by somebody in Germany. Now, the seller is in Germany, the buyer is in Nigeria. The goods will not come back to India. The goods will go directly from Germany to Nigeria. But it will be recorded as purchase in my books. It will be recorded as sale in my books. But goods have never touched to the Indian port. Goods have not touched to the Indian land itself. Goods have gone directly from Germany to Nigeria. Whether those transactions will also be liable to GST or not, that was a question. And which couple of court ruling have come saying that these transactions cannot be taxed in India because these are neither import in India nor export from India. So therefore, to put the rest, in 2019, they said that these transactions will not be liable to GST, and they put it in Schedule 3. Schedule 3 is a category where it is neither a supply in goods nor a supply of service, and accordingly, it is out of the tax net. That is transaction number 1. Transaction number 2, sale from custom bonded warehouse to DTA. Now, what is custom bonded warehouse? Because once the goods come from outside India, I'll take a simple example: is duty-free shops. If you travel abroad and if you're going and coming, then something called duty-free shops. Now, those are the places which are called custom bonded places. From goods cleared from custom bonded warehouse to DTA, whether that transaction will also be liable to tax or not. The question came that there are a couple of rulings of court came that it is export transaction and it is these transactions should not be taxed. So because of the rulings, because that place is treated outside India, and whosoever is filing bill of entry, he will be paying tax once, not twice, because there are transactions from bond to bond as well. Now, to put those things at rest, they brought in amendment in 2019 to say that these transactions will not be liable to tax, and they put it in Schedule 3. Similarly, high sea sales. Now, high sea sales is also a fictional concept, that goods are coming from outside India to India, and before the goods are cleared from the customs, somebody sold those goods. It means it is really a sale took place before goods have become part of the land mass of India. Once the goods are cleared from custom, they become part of land mass. But before they become part of the land mass, if there are some sale transaction happening with respect to those goods, those are called high sea sales transactions. Now, those amendments have introduced in 2019. Now, what they have done is, in this budget, they said these transactions will have a retrospective effect. So therefore, they made those amendments retrospectively from 1st of July 2017. Now the question arises, what is the impact of this? If we say exemption to pehle hi tha, abhi they are saying exemption is from 2017. How it is going to impact that? Now it has impacted in 2-3 ways. One, what are the pending cases going on? It means there are some matters where courts have taken a decision or authorities have taken a decision that saying these transactions are not liable to tax. But authority can say this amendment has come from 1st February 2019. Therefore, all the past transactions will continue to be taxed. Now, with this retrospective amendment, whatever pending cases are there, okay, whatever pending cases are there, those cases will get settled because of this very amendment. Another thing what they have said is, if somebody has already paid tax, then that tax will not be refunded to you. Now, this particular thing will definitely have an impact. As I said, the impact of this amendment is positive amendment for legacy issue, but denying refund is against the fundamental principle laid down in Article 265 of the Constitution of India. Now, what is Article 265 says? Article 265 says that no one can collect the tax without authority of law. Now, every tax collection has an authority of law. If there is no authority of law, then that tax collection is legally incorrect. Now, Parliament has amended the law saying retrospectively you are not liable to tax. It means what? From 1st of July 2017 onward, these transactions were not taxable. When these transactions were not taxable, it means whatever tax I have paid, it should come back to me, because whatever collection they have made, that is not as per the mandate given under Article 265. So therefore, that very particular thing, this collection of tax is against the spirit of Article 265. On that count itself, this very amendment and the portion of that amendment where they say that refund is not admissible can be challenged in a court of law. Because if there is any provision in a law which is against the Constitution of India, those provisions can be challenged in a court of law. The important point here is that if there is some principle called unjust enrichment, I will sincerely request all the students to at least go through once the constitutional bench judgment in case of Mafatlar. That very judgment laid down the fundamental principles of what is unjust enrichment. The principle of unjust enrichment is that if I have collected the tax from the customer and paid to the government, and later on government says this tax was not payable, can I get a refund from the government? And the principle of unjust enrichment is not a legal principle, it is a more of an economic principle, that you collected the tax from the customer, you are not paid from your own pocket, you paid it to the government, and now you are going to the government and asking a refund of that. It means you are doubly enriched yourself. So therefore, every refund claim will be hit by the principle of unjust enrichment. So therefore, if someone has already collected the tax and paid to the government, in that case, the refund is not admissible, despite you challenge the amendment on this particular thing on Article 265. So this is one part of this this particular amendment. Just a minute. Now, the second point is, now they have made a corresponding amendment in section 17(3) of the CGST Act with respect to that. Now, what is section 17 says? We all know that there is section 16. Section 16 says you can get credit ITC of all the inputs and input service which are used for providing, which are used in the course or furtherance of business. Now, section 17 says, if you are engaged in a business which is taxable supply as well as exempted supply, in that case, the proportionate reversal of ITC has to come. Section 17(5) talks about the negative list, that what all credits you cannot take. Now, we all know that being a chartered accountant, we all know how the calculation happens and how the number working happens. In case of you are doing both taxable and exempt supply, in that case, proportionate credit will be available. It means total credit taken into my taxable turnover divided by my total turnover. Now, if my total turnover component increases, okay, then overall reversal will be little higher. Okay. Now in this, and accordingly, if there are, if my what is to be reversed will be a mirror image. Total credit into exempted turnover divided by total turnover. And if my proportion of the exempted turnover increases, then my reversal will be a little higher. So that is the amendment they have made. So what this amendment says is that if you are doing some proportionate reversal, how to calculate the exempted turnover? In the value of exempted turnover, which I just now explained to you with respect to warehouse goods, supply of the warehouse goods to the DTA. Now, that transaction is neither a transaction in goods nor transaction in service. Still, they want to add the value of that supply in the value of exempted turnover, and accordingly the proportionate reversal will come. So this particular amendment will definitely have a lot of impact with respect to the amount to be reversed. So therefore, wherever you are dealing with the clients who are basically providing who are having taxable business as well as non-taxable business, in those cases, this proportionate reversal calculation will change. Keep this aspect in mind. But this particular amendment will come into the picture once it is notified by the government. So therefore, in future, this scenario will change. This particular part, amendment made in 17.3 is not a retrospective amendment. So therefore, we have to see when this amendment will get notified, etc. So this particular amendment, you should keep it in mind. Then now there are amendment which has come in section 17.5. So I would request my colleague Devan just explain about this particular amendment of
Yes, sir.
CSR.
As sir has rightly pointed out earlier that section 16 of the CGST Act, it provides eligibility for taking credit, right? But before I come to 17.5, it is very important to note that when GST was implemented from 1st July 2017, objective of the GST law was to remove cascading effect of taxes and to have one nation, one tax. Now, over the 5 years, 6 years down the line, what we have seen that a lot of changes have been made in section 16 and 17.5. Now, 16 also talks about what are the conditions for the availing credit, and 17.5, as said rightly said in the earlier slides, that it provides for a negative list. Now, beauty of 17.5 is that it starts with notwithstanding clause. It means that section 17, the legislature in manner it has crafted is that section 17 will override section 16 because it starts with the notwithstanding clause. Now with this 17.5, which again provides for negative list means the list of goods or services on which recipient may not be eligible for the credit. Now they have expanded the list over the years. Now one of the important change that have been done is and which will have an impact on the industry as well is with respect to addition of CSR expenses, means that the ITC on CSR expenses will not be eligible. Now what are those CSR expenses that has been covered under the Companies Act? Section 135 of the Companies Act provides that the eligible company need to incur 2%, minimum 2% of the profits of their net profits. Now what are these CSR expenses? These CSR expenses may be in the nature of providing infrastructure or construction of hospitals, schools, or relating or charity work to the NGOs. Now with the addition of this list, now ITC on these CSR expenses has been restricted. Now the mutable question which now arises for the industry, keeping an aside that is a cost to the business, what will happen to the credit which has been taken for the period from 1st July 17 till the amendment that will be implemented? What will happen to that credit? Whether that credit department will dispute it, or one can say that this amendment will have a prospective effect, because this amendment will not be beneficial for the taxpayers and it may impact the taxpayers at large. Now these are some of the questions which may lead to further litigation in the future with respect to the credit for the past periods. Now there are certain advanced rulings on CSR, and this matter has been highly litigated, not in the GST regime as well as in the service tax regime as well, where the tribunal, where the CSTAT has allowed ITC on CSR expenses. Now when GST came, taxpayers, they also went for the advanced rulings. Now advanced rulings, they have given very contradictory stand on these aspects. UP advanced rulings, they have said that company is eligible to take credit on CSR expenses. Reason is because these expenses are incurred in the course of business. Now if we see the expression of 16.1, it says that in the course of furtherance of business, and course and furtherance of business is too broad. Anything which is having nexus with the business will be eligible for the credit. Second point, they said that these are statutory expenses. These are mandated by the law, and any taxes paid on these expenses, the taxpayer will be eligible for the credit. However, on the other side, there are certain Gujarat advanced rulings and Telangana which said that ITC is not eligible on these CSR expenses because these have no nexus with the business at all. So they have gone that they are more of a CSR expenses are more in the nature of gift, and they said that this is bar under 17.5 and one may not be eligible for taking the credit. Now with this amendment, prospectively government has clarified their intention that the ITC on CSR expenses will not be eligible. But again, for the past periods, industry has taken the credit. What will happen to those credits? What will happen to the past rulings, CSTAT rulings? That will be decided in the due course of time. Now, one important aspect that we have tried to cover in this slide also by making an analogy with respect to the canteen expenses. Now, we know that in major corporate houses, usually, let's say in automobile, in a factory, they're having more than 250 workers, right? Now, under the Factories Act, a company is required to provide a canteen facility. Now, what are the emerging issues which are there in this area is, now there are two issues. One is usually companies having a canteen facility, but big corporate houses, they're not into canteen business. They usually outsource this business to third service providers, right? And they charge nominal amount or nominal salary, nominal charge from their employees. Now, there are two questions in this regard: whether an company is providing any services to their employee, whether is it taxable or not. And the second point is whether ITC is eligible on the taxes that I have paid to the service provider or not. These are the two questions which are still looming in this area, because ultimately these expenses are again statutory mandated, because this canteen facility that I'm providing to my employee, these are mandated under the Factories Act. Now, what will be the fate of those expenses now? So again, ITC, when GST was implemented, ITC has always considered to be heart and soul, like in a Constitution of India, Article 32 is the heart and soul. Similarly, ITC is in heart and soul. But again, as Supreme Court has said in one of the judgments, that ITC is not your absolute right. So government can put restrictions and conditions, and these conditions, if it is arbitrary, that can be subject to challenge. But if it is not, then one has to abide by those conditions. I think, sir, you may.
No, thank you. Very important point, and very lucidly you have explained. Just one point I want to clarify is that the inherent deviation made in section 17.5. One side, when you are giving credit on canteen, you are saying if it is statutory obligation, then you can get credit on canteen. On the same side, in the same very section, when there is a statutory obligation under section 135 of the Companies Act, you are specifically saying credit is not available. So therefore, again and again, as the famous judgment on Mahalakshmi Mills, and where Justice Chandrachud, at that time he was a judge in Bombay High Court, and now he is Chief Justice of India. He said that in that judgment, Mahalakshmi Mills, the credit is not your right. Credit is a sort of relaxation or sort of a benefit which the legislature is providing you. So therefore, while giving that benefit or relaxation, they are free to put any condition to that. So therefore, keeping this in mind, they basically keep putting. Definitely, with this amendment, past period will be taken care of. But in future, definitely it is going to be a cost to the company. So moving on from this, now this e-commerce operator, there are some penalties which have been imposed on the e-commerce operator. as you all know that e-commerce operators are liable to pay tax on behalf of the respective supplier and buyer, like Ola. The taxi operator is providing taxi service, but e-commerce operator is liable to pay tax on that. Ola is paying tax; these drivers are not paying tax. So, but our section 122 was making the person who is basically the supplier of the goods liable to pay tax. But there was no liability on e-commerce operator with respect to any wrongdoing done by the business partner who are operating on the portal of that e-commerce operator. Now, with respect to certain violation done by the vendor who are operating on the portal, now e-commerce operator will be liable to pay tax on that. So this is another sort of operational amendment, but it will have a serious implications on the day-to-day working of e-commerce operator. So this particular thing also you should keep it in mind. Now, this prosecution provision, beauty of tax law, and let me tell you for all professional and why we get so many query on income tax or indirect tax or GST or customs. Why we are not getting so many queries on, say, stamp duty and say other law day-to-day basis, because of the stringent implementation of it. And the stringent implementation comes when the lawmaker has a teeth and power to take some strict action. And we all sometimes looking as a chartered accountant, we sometimes think, arrest ki kyon power hai, why there is arrest, etc. And let me tell you, if these powers are not there, people will not come to us. These powers are the one which really make people fear to comply with the law. And once there is a compliance, then definitely there will be some advisory work, there will be some litigation work, there will be some of the other things. So these teeth in the law make the law implementable. If there is no teeth, there will be no implementation, and nobody will be asking questions on that. So therefore, we should definitely be very, very conscious and clear that what are the teeth in the law, where they can penalize, what penalty can come, who can be penalized, what are the quantum of penalty, what are the intensity of that penalty. So these particular things we should be definitely at some point of time. You may or may not be immediately, the focus will be on this, but keep that in mind. If you're really looking tax as a career, keep that in mind. This is very, very important. So what are the basic threshold? Now, basic threshold has now increased to 2 crore, but not in the case of fake invoice. So there are certain minor offenses which cannot be criminalized in a way that if somebody does all these violations, then person cannot be put behind the bar. Okay. So if you are obstructing any officer from discharging their duty, if you are tampering some evidences, if you are not giving some information what he is basically asking for, then you cannot be put behind the bar. Similarly, we're all compounding limits. If you want to really compound a particular offense, so those particular upper limit and lower limit have been amended and given as some benefit to the industry, but not in the case of fake invoice. Now, I think this very amendment made in section 16.2 could be relevant for your day-to-day working. We all know that if you are not paid to the vendor within 180 days, then you will be liable. Whatever credit you have taken needs to be reversed. So instead of reversing the credit, the law said that it will be added to your output liability. And then there was a question also whether this interest paid because of the violation of 180 days provision, whether I can take the benefit of section 50. Section 50 talks about if your accumulated credit is higher than the credit to be reversed. It means what? It means effectively you have not used the credit. And if you have not used the credit, then there should not be any interest, because the credit is basically compensatory in event. It means what? If you have not used the government money, then why shall I pay to the government? interest. So therefore, now with this amendment, this reversal is in line with other reversal. So that particular change which has really come. So whatever calculation, wherever you are helping your client with respect to the credit reversals, etc., please keep that aspect in mind, that this very amendment will definitely now help you. Mosumi ma'am, you want to say something? Now, another amendment with respect to with that whatever refund you will get. Earlier, there was some flaw in the language of section 54(6). When you get a refund, what will be the provisional refund? And for calculating the provisional refund, it says that provisional ITC will be excluded. Now, with this amendment, I think that was also a sort of a lacuna in the law. This particular thing has been taken care. Last point is very, very important. We all know that if you file a refund claim and if the money won't come from the government, we will get a interest. Now, how to calculate that interest? When do you say interest should be payable to you? Those particular thing which was not clear earlier in the law, now they have put more, given a more delegatory, they have delegated more power. If in a principle of law, and since I am talking to the student, so something called primary legislation and something called subordinate legislation. The primary legislation is a legislation which is passed by the parliament. Subordinate legislation is basically the legislation created by the implementer of the law. The parliamentarian are not the implementing the authority. They are only creating the law. In a parliament, they enact the law. And once the law is enacted, to further implement it on the ground, you require little more detailing. And that is why there are rules, there are notifications, there are circulars, etc. So therefore, when you are going for implementation of it, there also some law are being framed. So that particular power they have delegated, that how to calculate that interest on the delayed refund, those particular amendment have also come. So therefore, this is a very fundamental principle of administrative law. The principle of administrative law is the subordinate legislation cannot go beyond the main legislation. Okay. First is constitution, second is our primary legislation, and third is the subordinate legislation. Therefore, in that sequence, this whole thing should work. So they have given more power to the implementing agencies, that they can decide how to calculate that particular refund. Now, other substantive changes which have really come is basically now the benefit of composition scheme is extended to the dealer operating through ECU. We all know that earlier this benefit was not available. So therefore, wherever you are dealing with a client who are likely to operate through ECU, and if their turnovers are within that range where the benefit of composition scheme is available. So I think from a compliance point of view, you need to keep this particular aspect in mind. Consent-based sharing of information of taxpayer, I don't think it is very relevant at this juncture, but there is some amendment has come with respect to that. Now, if they have to share the data with income tax or for some other agency, they will seek the consent of the assessee. I believe this is IWASH. Anyway, they have been sharing the data with each other. So this is not very, very relevant, at least from a student's point of view. Now, this particular amendment will definitely have impact with respect to your compliance, because maximum time limit of 3 years they have specified for filing GSTR 3B, GSTR 9, GSTR 8, etc. Because if there are some past non-compliances which you could do it compliance today, even though practically it was not possible, but still there are cases when you could amend those particular things. Now no such amendment is basically possible, and no such filing with respect to GSTR 3B, 9 and 8 is now possible. Another amendment which has really come is we'll keep few minutes in the last for some question answers, and there is amendment in section 23 which has also come. That is also very important amendment. If any of your client who are not liable to pay GST, like lawyers, first of all, a lawyer will be your client, and if they are if they are not liable to pay GSTs, or maybe say doctors, in that situation, reverse charge registration will also not be there. So I think that particular amendment with respect to who should be registered and what all the relaxation for that. So they have given special status to section 23. We all know that 22 talks about 20 lakh rupee return. 24 talk about mandatory registration. 23 has been given a special status. It means 23 can override what 24 also says. So therefore, if you are dealing with totally exempted goods or services, you are not liable to be registered under GST, even if your case fits into section 24. Now, in IGST also, there are two amendments which have really come. One is OIDR, online database access and retrieval service. Some definitions have been amended with respect to essentially automated human interventions. So this particular thing has been changed. Most important change in section 12.8. If any of your client is doing some transportation from India to abroad, earlier those transactions was export of service. Now with this amendment, in nutshell, I am saying these transactions cannot said to be export of service. This transaction will be a local supply because of the specific amendment has made in section 12.8. So therefore, if there are some outbound transportations from India to abroad, those transactions will now be liable to GST. If your customer is in India, so your supplier is in India, customer is in India, goods are going from India to abroad, earlier those transactions were not taxable. Now those transactions will be taxable because of this very amendment. So I am just rushing because of I'm only focusing on which is most important for you. Now in customs, there are 2-3 amendments which have really come. Couple of years back, in 2021, some amendment has come that every exemption notification will have a life of 2 years. But they later found that there are some notifications which cannot have a life of 2 years because either they are linked with free trade agreement, or they are linked with foreign trade policy, or they are linked with some other legislations, etc. So they said that then they have list down what all the categories in respect of which the minimum this mandatory expiry period of 2 years will not be applicable. That particular thing they have mentioned. So this is also more of plucking the lacuna in the law and giving benefit to the industry, and especially they have reduced their own pain. Otherwise, they have to remember. Now, this settlement commission is very, very important. I'm not sure whether your clients are planning to go for settlement commission, but now they have set up a time limit of 9 months to decide the matter by the settlement commission, and it can be extended by 3 months. So it means within a year, the settlement commission has to close the matter. If settlement commission is not able to close the matter within that 1 year time, then matter will again come back to the original authority. And if the matter comes back to the original authority, it will have a serious implications because then the prosecutions and other things will also come. Now, before I discuss about, I'm not going to discuss with you what all the rate changes which have come. I think you can go through that. I will only say to all of you is keep the classification principle in mind, and classification is very, very important. How to do a classification? It is a very systematic way of reading the tariff, and our tariff is very systematically and therefore are systematically bifurcated. So there are live issues and plants, and then goes on and goes on, and it ends up the vehicles and other things. So therefore, how to do a classification? It is a subject which require a knowledge of the industry, knowledge of the product, and ability to read couple of things together, and then systematically going through that. If you are interested in classification, I think we can spend some time. What is the importance of single dash? You will see there are dash like 4 dash, 3 dash. What is the importance of single dash? What is the importance of double dash? What is the importance of 3 dash? What is the importance of 4 dash? Classification is a very, very important area. Let me tell you, all my friends, maximum litigation in another 5 year to 10 year down the line will be in the space of classification only. And these litigations are high stake litigations, because it will impact your import business, it will impact your domestic business, it will impact your all debit note, credit note issues. So classification is going to be very, very, I will say, interesting area, and very, very complicated area also. And to understand the product and very smart level of product, whether it is a thermal camera or whether it is a sensor, these are complicated questions. Whether it is, I will say that static converter or a rectifier, to understand the difference in these two products are quite complicated. So therefore, classification, to my mind, is going to be the big area in practice in days to come. So I'm not going to discuss what all new entries have come, what are where the rate has been reduced or increased. I think that you can go through, but just keep this aspect in mind. And and for the rate, nobody can remember, nobody can memorize. So therefore, every time you should have a habit of how to open the tariff, when to see a rate. Don't Google it, and Google is the biggest disruption. And if you say that while doing the Google and this new chat which has really come, you will get an answer, you will not get an answer. So therefore, how to read multiple things, how to identify the rates, what all the new notifications which have come, new thing which has come, impacting one chapter with other chapter, please have a look at it. And if there are some specific questions you are having, I can separately talk to you one-on-one to give you the answer on that. Now, the last thing is with respect to some CST tribunal which has which was not functioning. Now, CST tribunal, you will be saying, what is CST? We are in the business of GST. This is called CST. Old issues are pending, and CST tribunal was the one which is different from our VAT tribunal. What it's there. If there are issues, whether it is interstate supply or a local supply, which authority should decide? So there was a central sales tax tribunal which was there, that was not functioning. Now all those matters will now be handled by the CSTAT. CSTAT are Central Excise Service Tax Appellate Tribunal. So I think CSTAT is going to handle all those legacy issues. Then in the last, we have captured a couple of case laws, just to give you a sense that what all the new amendment which have really come, or the new case laws which have really come. This voucher, this Karnataka High Court judgment has come, which says the vouchers are neither goods nor services, and therefore cannot be taxed under GST. I think this is a good judgment, but personally I have some different view, because voucher definitely may not be goods or service, but voucher is the one which gives you the entitlement. And entitlement means a right. If you get a right has a connotation of a property, and once something is a property, then that transaction should be taxed. But the way the vouchers are given treatment under GST law is slightly different. But in a common parlance, once I get a voucher, I get an entitlement. Entitlement means what? Entitlement means I have a right. if I have a right, it means there is some property inbuilt in it. If there is a property inbuilt in it, that transaction has to be will fit into the definition of goods, because goods means all movable property. Okay, anything which is a movable property should be fitting into the definition of goods. So therefore, personally, I don't agree with this Karnataka High Court, but the way our GST law is worded seems to be a correct judgment. But I will say that this is also an area which will have a lot of disputes in going to come because of our reward point, because of our so many promotional points which we keep getting, etc. How the whole business is really coming into this space, and there are so many players which are operating only in this area. So therefore, one has to keep this aspect in mind. And there are some couple of other judgments have also come. I think we are running short of time. Maybe we'll take up questions. Somebody asked a question. If you have any questions. Now, person supplying e-commerce, supplying through e-commerce operator need not be. Yes. Yes. If that person is dealing with some pure exempted goods and services, then the GST registration need not be taken by that particular SSC, which was earlier mandatory. So I think there are some rulings. I think maybe I don't want to take up the time of Chirag. Maybe we'll discuss at some other point. So I'll happy to answer if you are having any questions.
So we even have a question. Webinar. So
नहीं, हम आपको सुन नहीं पा रहे.
hello.
Yeah. Yeah, Sairam, we are not able to hear you.
I will just check out YouTube link. वहाँ पर अगर कुछ queries होगी तो I will just let you know. Please give me some seconds.
Yeah.
सर आपने इतना अच्छा से सेशन कंक्लूड किया है, तो इसकी वजह से देयर आर very limited doubts. That's you have already
very
covered
humble.
up.
You are very humble. Indirect tax is quite complicated also, and probably I focused more on the law aspect than on. I have not taken them through returns and how the data is going to flow. Probably maybe little either the more easy or the more complicated. Anyway.
But it was fantastic, sir.
Thank you. Somebody asked a question: if person dealing in taxable goods, then तो लगेगा ना, तो GST number चाहिए ना उसके लिए फिर. If you are dealing with the taxable goods and if your turnover is more than 20 lakh, so then there is no brainer. And if you are dealing with the taxable goods, you can go for a composition scheme also. So therefore, all those things will continue. If you are dealing with pure exempted, only in those cases you are not liable.
Okay, sir. Before we proceed further, we are blessed to have our Ketan Sayya, sir. He is a WRC Vikasa chairperson. I request Ketan sir to please enlighten our students.
Thank you, Rishikesh. First of all,
let me compliment the Pune branch for hosting budget seminar for the student. I think it's amazing. Both the speakers.
I'm not able to hear.
Yeah, even I.
Absolutely great. Sir, really grateful on behalf of the entire Vikasa WIRC, Pune, Satara, Anand Ketanji is here. Ketan Samdani from Anand is here. Sir, for all the Vikasas, let me explain you only one point, that this seminar is not restricted to the attendee who are attending now, but this recording, we put it on the website with the permission of the speaker. And generally we have seen that the at least 10 times of the attendee, for example, if there are 30 attendee today, there will be 300 views within 1 week. And that's the new generation. I mean, they like to watch at their own time, as per their own convenience. And of course, the utility is great. So, sir, really, really grateful to both of you for sparing your valuable time.
Thank you.
Coming to the budget, I think, first time something out of box. I personally feel, apart from direct tax, indirect tax amendment, we should also look at the some aspect of economy, which is, sort of an example of the introducing concept of Saptarishi. I think, fundamentally completely different budget, spending almost 10 lakh crore rupees capital expenditure, which is, sort of encouraging that the entire economy will get changed if the government will spend, 10 lakh crore rupees on capital expenditure. So the kind of development which are going to happen, we cannot imagine today. Maybe in 3 years, 5 years time, we'll see a completely new India further. And I think hats off to the government, the people who have thought over about all those things. So I personally feel, as a student, all of us, as rightly said by Sandeep sir in the beginning, we all are even students. We must think about what is being done and what will be the implication in coming years on the entire economy and India emerging as a global leader. I think this is a right step taken by the FM as well as the entire team of ministry to put India on a fast track of growth. So I think that aspect also, being, intellectual people, we must study the economic part and the future of India also. I think this is one good budget which I have seen in last few years since whatever, time we have been seeing, almost since last 10-20 years, we have been seeing budget. I think one of the different budget, and where government has thought out of the box. And this is going to be a really, really game changer for the coming time for India. So with this, thanks to Rishikesh, thanks to Maushmi and the entire team of Pune Vikasa student. My compliments to them for, organizing this sort of seminar and having Chirag sir, having Sandeep sir here. Sir, once again, thankful to all of you. And thanks to Pune branch, and compliment to Pune branch for making us, part of this event. Thank you so much. Over to you, Rishikesh, again.
Yeah, just one point I want to mention to what Ketan sir has just now mentioned about government spending. And this is a very emerging area which will be a big professional opportunity in days to come. And this is not only for students, this is all of us. This is for all of us. More and more government spending, it means the government will not directly spend. Government will engage some contractors. Government will go back to the industry, and somebody will be manufacturing coaches, and somebody will be manufacturing rails, somebody will be setting up the roads, and somebody will be manufacturing some automated products, etc. Now, and my experience in last couple of years, and mainly into the commercial disputes, wherever government comes up with the contracts with the private parties, invariably there are some contractual issues, there are some contractual disputes, there are some arbitrations, there are some commercial conflicts. And I must say that this is the area, and this is going to be very emerging area. And we should definitely have a close watch on this. And this is not a message only to the student. Obviously, tomorrow the student can pick up any of these areas at a later stage. But as a professional, I will say that instead of now focusing only on core classical issues, which you have already been doing, either tax advisory or financial advisories and doing accounting or auditing, etc. Conflict between the parties, and especially the commercial conflicts, big area. And I can vouch, the more and more governments spending, the bigger the space of these practices. Thank you.
Very true, sir. Thank you so much for being here.
Thank you.
I would also like to thank Ketan Sayya sir for immediately agreeing to be with us for this event. Thanks a lot, Ketan sir, as well. Over to you, Sairam.
Thank you, ma'am. Thank you, Devang sir, also for providing the insights. Now I request Vikasa. Hello, am I audible?
Yes.
Yeah, you're audible.
Sorry. Yes. Now I request Ketan Samdani sir, Chairman, Anand Vikasa, to present the vote of thanks.
Am I audible?
Yes, sir. Yes, sir. Ketan sir, you are audible.
So your voice is slightly cracking.
Hello.
Yes, sir.
Hello. Am I audible now?
Yeah, you're audible. Probably we continue. The voice is slightly cracking. Let's check.
Okay. Just a sec. I'll move into better network area. Hello.
Yeah, now it's better.
It's better now?
Yes, sir.
Okay. First of all, thanking Ketan Sayya sir, Vikasa Chairman, for giving us opportunity to join this wonderful event. Thanking our speakers, C.A. Chirag sir and Sandeep sir, for sharing their knowledge. And thankful to all the participants for attending. Thank you all. Over to MOC.
Thank you, Ketan sir. Moving forward with the session, I request Honorable Vikasa Chairperson, CA Moshmi Shah ma'am, to introduce our next speaker, CA Chirag Chodia sir. Please, ma'am.
After having such a wonderful highlights and analysis of the Union Budget 2023 GST part mostly, we have another fantastic session, and the session speaker, CA Chirag Chodia sir. Let me quickly introduce you to CA Chirag sir. He's a chartered accountant with expertise in the field of direct tax, international tax, business and transaction advisory, currently working as a manager at Globeview Advisors LLP, a boutique consulting firm delivering tax center business advisory services. He has earlier worked with KPMG for more than 3 years in mergers and acquisition tax with focus on transaction advisory, tax due diligence, and internal restructuring projects. He has also worked at NA Shah Associates LLP in Mumbai in direct and international tax team. He has co-authored various articles which have been published on forums like Bloomberg, Your Story, NDTV, Taxman, TaxSutra. Very happy to have you, Chirag sir, over here at this forum, and we are really eager to listen to you and your reviews on the budget 2023 from the direct tax point of view. Over to you, sir.
Thank you. Thank you. Thank you, Moshmi ma'am, for the kind introduction. It's truly a pleasure to be addressing the audience today. And yeah, so without any further ado, let me just share my screen, and maybe you can just let me know if my audio is clear and the screen is visible.
Yeah,
Yes,
you are
Chirag.
audible, and the screen is also visible.
Great. Okay. So maybe before starting with the budget session, can I get a few yes or no on whether has anyone tried ChatGPT? Okay, Pranav says yes. Thanks. Anyone else who has tried ChatGPT? Smurti says no, Tejaswini says no. Okay, so for those who have not tried it yet, I would really recommend you all to go and try it. It's a very interactive kind of a portal which allows you to ask any question and gives you answer back in the form that you would, want to hear. So before the budget was, announced in the on 1st of Feb by the finance minister, I asked ChatGPT as to what an ideal budget should be like. And it gave us such a wonderful answer. As you can see from the screen, it says you have to boost economic growth, you have to support agriculture, strengthen infrastructure, and so on. So that's a wonderful answer. And this budget has, to some level, complemented and met these expectations. And as Ketan sir was earlier mentioning, that it's a wonderful budget and has brought in a lot of good changes, and the capital outlay of 10 lakh plus crores and so on. So that's the highlight from this particular budget. Now, coming to the income tax highlight. So there are about 122 amendments that are brought in by the Finance Bill 2023. And as Finance Minister also mentioned in the speech about Saptarishi, I have divided all these amendments into 7 different categories. Now, today, giving the time constraint, I may not be able to cover all the 7 categories. So this PPT would obviously be shared with all of you and you can have a look at it. But what my target would be is to complete the most important and the most critical amendments that are that would help you for your articleship, for your profession, as well as for your exam point of view and from a studies point of view. So without wasting any time further, I'll just quickly come to the tax rates. So in this particular budget, there are no changes in the old tax regime as such. There are few changes in the new tax regime for individual HUF, AOP, BOI, and artificial juridical persons. We will discuss this in detail later because this is one of the biggest changes that has been brought in. The second category of taxpayer is the domestic company, wherein there's no change as such. And you have the old regime for the domestic company continues to be available at 25% rate and 30% rate. And the new regime continues available on 15% and 22% rate. For a foreign company, tax rate remains unchanged at 40%. For a firm, limited liability partnership or a local authority, tax rate remains unchanged at 30%. For cooperative societies too, there's no change in the slab rates. There's just one introduction for a cooperative society, and this is maybe in line with Prime Minister's objective to support small businesses. They have also, so the change is that they have brought in the new tax regime for a cooperative society also. And for those who are conducting manufacturing activities, they now have a reduced tax rate of 15% available. AOP, for in which only the companies are members, for them the surcharge shall not exceed 15%. And for the cooperative societies that are opting for the new tax regime, the surcharge shall not exceed 10%. So, this is just a brief overview around the tax rates, and now we will get into the amendments. But before going over there, I would really encourage you to ask questions as and when we go through the slides. I will be a little quicker so that I can complete most of the critical amendments. But in case you want me to go slow on it, you can please type in the chat box and we can then work around the speed as well. So coming to the personal taxes. So this is the biggest change, I would say, in the Finance Bill 2023. And this is the most talked about change too. We will now try to, completely decode the new tax regime and also try to figure out as to how do we make a choice between old regime and the new tax regime. So to do that, let me first take you to the history of the tax rates. So there was an old regime which is in existence for a long time. And as you know, the basic slab rate is 2.5 lakhs for those under 60 years of age. They don't have to pay any tax on that. For those in the category of 2.5 to 5 lakhs, the tax rate is 5%, 5 to 10 lakhs is 20%, and more than 10 lakhs is 30%. These are the base tax rates. Finance Act 2020 had brought in a concept of new tax regime. This was brought in under section 115 BAC, and a few different slab rates at a difference of 2.5 lakhs was introduced, which effectively allowed income of up to INR 15 lakhs to be taxed at the rate which is lesser than 30%. And income above that particular limit of 15 lakhs was to be taxed at a rate of 30%. Now, Finance Bill 2023 further targets to make this new tax regime lucrative. The reason why government or the finance minister is trying to make the new tax regime lucrative for all is because it is very easy to implement. For taxpayers, it is very easy to comply with this particular new tax regime. And so taking you through the slab rates, over here, they are increasing the basic exemption limit from 2.5 lakhs to 3 lakh rupees for everyone. The tax rate for up to 3 lakh rupees remains nil. For income more than 3 lakhs to 6 lakhs, the tax rate is 5%, 6 to 9 is 10%, 9 to 12 is 15%, 12 to 15 is 20%, and more than 15 lakhs, it's 30%. So this is the new tax regime, and we will come to as to what amount of taxes can you save when you adopt a tax regime. We will look at it with an example. But before that, when you go for the new tax regime, the government doesn't allow you certain deductions, certain exemptions. Now, along with that, there are certain other changes that have been made. So firstly, earlier this new tax regime was available only to individual and HUF. Now they've extended it to AOPs, BOIs, and artificial juridical person too. Basic exemption limit, as we saw, has been increased to 3 lakh rupees. As you would be aware, for those having agriculture income, you need to calculate the income tax through a different mechanism by adding the entire income by 2 mechanisms, and then you take out the difference and you pay taxes on that. So this revised limit of 3 lakhs will also be available for those who have agricultural income. There's a standard deduction of 50,000 available under section 16 for those who are salaried people. So for salaried individuals, in the last tax regime that was introduced by Finance Act 2020, the standard deduction was not available. Government has now extended this benefit to those under new tax regime as well. Similarly, under section 57(2)(a), which is under the income from other sources head, so there was a deduction available on family pension, which was available only under old regime. It has now been extended to those adopting for the new regime as well. There is a new deduction which is available for those depositing in Agnivir Corpus Fund. The government has clarified that any deposit in that particular fund will also be available as a deduction under the new regime. Now, over last few years, there have been a lot of amendments on surcharge. And so surcharge have been increased steadily, and till last year, the maximum surcharge rate could go up to about 42.74% for those having income of more than 5 crores. What government has done this time is that they've proposed to restrict the maximum surcharge to 25%. Earlier, it was 37% for those having an income of more than 5 crores. Now it is restricted to 25%. So this brings down the highest effective personal tax rate from 42.74% to 39%. So that's a straight away approximately 4% saving for those in the higher tax bracket. There's a catch in this surcharge, which is that this reduced surcharge rate is available only if you're adopting the new tax regime. If you're adopting the old tax regime, the surcharge shall not be reduced, and you will be continued to tax at a maximum ETR of 42.74%. There's a rebate section 87A2, wherein what it provides is that for those under the old regime and have an income of up to 5 lakh rupees, they don't have to pay any taxes. But say you have an income of more than 5 lakh rupees, say 5 lakh 10,000, then you do not get any such rebate under section 87A. What the finance minister has proposed is that, and if you're adopting a new regime, they will increase the rebate limit from 5 lakh to 7 lakh rupees, and up to 7 lakh, there's no need to pay any taxes because you get a rebate of INR 25,000. There's an important point for you to note over here is that this particular rebate is not available to HUFs. It is also not available to non-resident individuals. So these are broadly the key amendments under the new tax regime. Now, when this particular new regime was introduced in Finance Act 2020, what it said is that you have a old regime available, and if you want to go for the new tax regime, you can make that choice. This time what it has been proposed is that the new tax regime will be default, and if you want to go for old regime, you can make that choice. So which means the new tax regime is now the default option available. This doesn't affect those having income only from salary or capital gains, because they can make this choice every year. Say in year 1, I can go for old regime if that is more beneficial. In year 2, I can go for new regime. In year 3, I can again shift back to old regime, and so on. That's not a problem for those not having any business income. For those having business income, this flexibility is available only once. So which means while filing the return, if I say no, I don't want to go for the new regime, which is the default option, I want to make a choice and I want to go for the old regime. So that I can do. Now in year 2, I decide to shift back to the new regime. I can do that. After that, I cannot again go back to old regime, and I will have to follow the new tax regime. So that is a critical change for those having a business income. Now, moving to the exemption and deduction. So obviously in the new tax regime, as you can see that the slab rates are, quite flexible, and you get a benefit out of it. And the government is moving towards ease of compliance, ease of implementation, ease of assessment. And hence what they have proposed to do is the various deductions or exemptions that are available under multiple sections of the Act, they have tried to bring those they have tried to reduce those. And so what they are saying is that if you go for the new tax regime, certain deductions and exemptions will not be available. I have divided this into two portions. One that is relevant for individuals, and second that is relevant for businesses. On this slide, you are looking at those deductions which are relevant for individuals. So leave travel concessions, which is typically 1 to 2 lakh rupees, HRA, then a key would be section 80C, which is life insurance premium, ELSS, any principal repayment. Then again, any interest on loan for self-occupied property, any health insurance premium, all these deductions you will have to forego, and this will not be available if you are adopting for new tax regime. So whenever you're making a choice between old versus new, you have to consider two things. One is the reduced slab rates, which is a benefit under the new old regime, but you also have to consider the deductions that you have to forego. Now coming to those deductions, exemptions which are available for businesses. So there's a section 10AA for SEZ units. There's additional depreciation. There's depreciation on plant and machinery in backward areas. Tea, coffee, and rubber development, they have a special allowance for them. So all these are, these are some of the deductions that the businesses will have to forego. Just one clarification is that I've mentioned 80C, 80CCD, 80D, 80G from Chapter 6 set deductions, but it's not that only those deductions. In fact, all Chapter 6 set deductions are something that you need to forego, except for few sections which are available. That is 80CCD2. This is on behalf of pension. 80CCH2, which is for the Agniveer Corpus Fund. In 80JJAA, which is for generation of new employment. So these deductions will continue under the new regime. All other deductions under Chapter 6A will need to be followed. So I'll take a pause here and I'll just check if there are any questions. Aditya says that there was an increase in standard deduction to 50 to 500. So yes, Aditya, I recall that finance minister made that announcement in the speech. But when we read the fine print, what we observed is that there's no increase in the standard deduction amount. 50,000 is being made available, and this 50 to 500 is a slightly different calculation. It was a calculation of tax saving, which was mentioned by the finance minister in the speech. But in the fine print, there's no increase in the standard deduction. Are there any other questions? Okay. So now let's move on to, we saw the old regime, the tax rates available, the new regime tax rates available, the deductions and exemptions that we need to forego. But how do we make that choice of adopting an old regime versus a new tax regime? So over here, we used Excel. That is what we chartered accountants do. So we opened Excel, we tried a number of scenarios, maybe 15, 20 scenarios of different level of income, right? From 6 lakh rupees to 10 crore rupees. And then we tried to analyze the data as to what is the amount of tax saving that one can do. So we started with a simple example wherein a person has certain income, say of 10 lakh rupees. And he goes for old regime. So he doesn't have any deduction or exemption that I mentioned earlier. And he wants to make a decision between old regime and new regime. So obviously new regime will be beneficial for him because there are no deductions that he needs to forego. At the same time, he is saving from the slab rates. So we tabulated what is the maximum amount of tax saving that one can do. So up to INR 10 lakhs, the maximum tax saving for him would be 54,600 by adopting a new tax regime. For 15 lakhs, it would be 1,17,000. 15 lakhs to 5 crores, the tax rate on the additional income remains 30%. But what changes is the surcharge rate. So up to 50 lakhs, there's no surcharge. 50 lakhs to 1 crore, 10%, 1 crore to 2 crore, 15%, 2 crore to 5 crore, 25%, and more than 5 crores, there's a surcharge of 37%. And this surcharge is resulting in a difference of the tax saving amount. So as you can see that it's incremental at each slab rate. And when you go beyond 5 crores, new regime becomes very much beneficial for the taxpayer because there's a flat saving in tax rate, as we discussed earlier, of about 3.74%. So then we thought of, summarizing how to take a conclusion between the old regime and the new regime. So if you want to make a choice, or a friend comes to you and says that, how do I make a choice between whether I should go for an old regime or whether should I adopt the new regime? If there's a person who has income of up to INR 5 lakhs, he shall be indifferent because in both these regimes, there will be no tax payable. For a person who has income between INR 5 lakhs to INR 7 lakhs, the person may go for the new tax regime. Reason behind it is the rebate. Because under the new regime, you get a higher rebate and any income up to INR 7 lakhs is not taxable under the new regime. It becomes tricky for those having income between INR 7 lakhs to INR 15 lakhs because of the deductions available, because of the slab rates that are multiple slab rates that are there under the new tax regime. And so this particular category, we will have to analyze basis each of the facts of the case as to what is the deduction available. We need to compute both the taxes under both the regimes and then take a decision. For those having income of more than 15 lakhs to INR 5 crores, what we observed is that if a person has deductions equivalent to INR 3,75,000 or more, in that case, old regime will become beneficial for a person. And I will try to explain the math around it. So what happens is that after 15 lakhs, tax rate between the old regime and the new regime is same, that is 30%. From up to 15 lakhs, the base taxes, if you calculate under the old regime and the new regime, under the old regime, the base tax up to for the income up to 15 lakhs is 2,62,500. Under the new regime, it is 1,50,000. So the difference comes to around 1,12,500. Now, if you divide 1,12,500 by 30%, this gives you an amount of 3,75,000. And this is exactly the amount of deduction that you need to avail to so as to become, because if you forego your new regime, you will have to be paying additional 1,12,500 of taxes. But if you avail old regime and you take deductions of 3,75,000, you will have a saving equivalent to 1,12,500. So at 3,75,000, both the regimes become indifferent. And if your deductions go beyond 3,75,000, you have higher tax savings. So that's the formula for those having income between 15 lakhs to 5 crores. You just have to tell them one number, that if you have deductions more than 3,75,000, you can just make a choice of going to old regime. Of course, ease of compliance under the new regime is a separate question altogether, and it's a different perspective. But on a monetary level, clearly, for 15 lakhs to 5 crores, it makes sense to go for old regime if the deduction amount is more than 3,75,000. Now, for those having INR 5 crores of income, new tax regime seems to be more beneficial, for the simple reason that the surcharge results into a 3.74% of tax saving. So that helps you a lot over here. And so this is how we try to summarize the new tax regime, or making choice between the old regime and the new regime. I'll just take a pause, and if there are questions on the calculations, I can take that up. Okay, so since there are no questions, I can move ahead with the slides. And one point from a policy perspective. So when we saw this regime, we just thought, is government demotivating to invest? Or earlier there were certain incentives available under Section 80C. If you invest in a house property, if you invest in LIC, if you invest in some mutual funds which are under ELSS. So all those kind of investments people used to make because there was one more advantage available to them, which was of tax saving. So, well, adoption of new tax regime make will demotivate people to save. But what we have been reading, or what we understand, is that now the society is Indian community is maturing, and everyone really understands the need of savings and need of investments. So with this maturity getting into the system, these deductions may not really be required. So it is not that the tax is the factor of, or the motivating factor alone for making those savings. It is investments and the development that they want in their lifestyle. That itself is a good motivating factor nowadays. So that could be the thought process. And with deductions, there come a lot of complications, and it results in a huge effort spent on the side of the government, both monetarily as well as from a time perspective. And with adoption of new regime, it is going to be very easy, very simple for the government to assess the incomes. So that's my take on the new tax regime. Aditya has one more question. Do you think the changes in new regime has made it attractive? I personally believed if they increase basic exemption limit to 5 lakhs, only then it can become attractive. So Aditya, as I mentioned earlier also, the new regime has become attractive for those, of course, who have income more than 5 crore rupees. For 15 lakhs to 5 crore people, it has become attractive if they have deductions which are lesser than 3,75,000. While of course a higher basic exemption limit will make it even more attractive, but that is something for us to wait and watch till the next budget or the next to next budget is announced. So we'll just wait for that. Now coming to the next big change, and this is the theme that we observed while we were reading the finance bill. So government has recognized that people who are in the category of HNIs, that is high net worth individuals, they have various tax saving avenues available, and they have been taking a lot of advantage to it, which a common man is probably not being able to do that. So we've brought in a few amendments. The first one of it is around the deduction for capital gains. So you would be aware that when you sell a house property, if you invest the capital gains amount from that house property, your so if you invest the capital gains amount from a house property into another residential house property, then you are eligible to get a deduction under Section 54. Similarly, when you sell any asset with other than a residential house, in that case, if you invest the net sale consideration that you receive upon sale of that particular asset in another house property, then you get a deduction under section 54F. This was brought in to give benefit and to let people invest in house properties primarily. What has been observed in last few years is that people who have good amount of wealth in their hands, they escape paying taxes because they invest in very premium villas, very premium apartments, which have a high value. If you would have read recently, the promoter of DMart, has made a serious investment in residential properties very recently in the last week, and that gives you some sense of as to how these deductions are being used by various people. So government has now brought in an amendment, and what they have proposed is that the investment in any new residential property exceeding INR 10 crores has to be ignored. We'll try to understand this with the help of an example as to what does it mean. So let's first take an example of a residential property. That is a case which falls under section 54. So you have net sale consideration of 100 crores. You have index cost of acquisition of 80 crores. So your long-term capital gains is INR 20 crores. If you make an investment of 15 crores, so since your capital gains is 20 crores, earlier it was possible to take the entire 15 crores as deduction. But now with the limit of investment in new residential property being maximum 10 crore rupees, your allowable deduction is restricted to 10 crores and you will have to pay tax on the remaining 10 crores, which is 20 minus 10. Now coming to the next example of LTCG in case of shares. So this falls under section 54F. So you have a net sale consideration of 100 crores. You have index cost of acquisition of 20 crores. You have capital gains of 80 crores. Now, as I mentioned earlier, in 54F, you have to invest the entire net sale consideration as against the capital gains in 54 cases. So you have to invest entire 100 to take a benefit. But what government says, so, and this person who has long-term capital gain shares, he invests the entire 100 crores too. Earlier, this would have been a scenario of no capital gains tax. But now what it says is that any investment more than 10 crores is to be restricted to 10 crores. So what you will do is you will take long-term capital gains of 80. You will multiply it with maximum 10 crores of investment. You will divide it by the 100 crores, which is the net sale consideration. And this gives you allowable deduction of only 8 crores. So as you can see, there's an investment of the entire net sale consideration, but even then deduction is restricted only to 8 crores because of the proportionate mechanism under section 54F. So this is one key change that's there. Now coming to the next change, which is on interest on housing loan. So whenever you acquire a property, a residential property, and you take a loan or you borrow money from banks or financial institutions, you pay interest. And that interest is available under various sections of the income tax. Firstly, it's section 24, which is wherein while computing your house property income, you're allowed to take a deduction of interest up to 2 lakh rupees. Then there's section 80EE, which allows for certain set of residential houses. If the loan was borrowed and the investment in those houses was not exceeding 50 lakhs, it gives you an additional deduction of around 50,000 on the interest paid. There's section 80EA, which again gives you an additional deduction of 1,50,000 for certain investments. What happens is that whenever you compute your income from house property or whenever you compute your tax liability for that particular year, you reduce this interest. People were also claiming this interest as cost of acquisition when they were, ultimately, so say in year 1, I paid interest, I claimed deductions. In year 2, again, I did. So I did this for next 5 years. In year 6, I decide to sell the house that I had bought. So I would again compute my capital gains. I would take my sale consideration. I will reduce my index cost of acquisition. And while calculating this cost of acquisition, people were again taking a deduction of the interest that was earlier taken by them under section 24B or under chapter 6A. So this was resulting in a dual deduction. There were contradictory judgments of courts in India. So ITAT Chennai allowed this particular dual deduction also. They said that since house property and capital gains are separate heads of income, there is no problem in claiming the interest benefit under both the heads. Whereas Karnataka High Court, in a old judgment, it was slightly on a different footing, but it had said that any particular expense cannot be claimed as a dual deduction under the Income Tax Act. So there were contradictory rulings, and Finance Minister this time proposed that if any interest is being claimed under, say, 24 or under any Chapter 6A, in that case, that particular interest will not be available as cost of acquisition or cost of improvement. So that's a loophole that they have tried to plug in. Next, again, is a very critical amendment. And as I mentioned earlier, there are various amendments that, target or not target, but that have an impact on HNIs. This again could have a very huge impact on them. So life insurance policies, there's a section 1010D under the Act, wherein if you invest in life insurance policy and subsequently you receive any amount on maturity, in that case, that particular maturity amount is treated as exempt. Earlier, through 2-3 years back, government observed that there are certain unit-linked insurance plans wherein insurance is not a primary factor, but investment is a primary factor. And they wanted to demotivate such investments. So they brought ULIPs under the ambit of taxation if the premium of such policies exceed INR 2.5 lakh rupees. Now they have observed that there are certain life insurance policies too, wherein the premium is very high, the maturity proceeds are very high, and people are taking the exemption benefit for such policies. So what they have said is, for any policies that are issued on or after 1st April 2023, if the premium of such policies exceed 5 lakh rupees, in that case, any maturity proceeds from them will not be exempt and those would be taxable. They have also clarified that this would be taxable under income from other sources, and any premium amount that has not otherwise been claimed as deduction will be reduced from the maturity proceeds. So say in 5 years, you pay a premium of 6 lakhs each, and ultimately you receive 1 crore from that policy, hypothetically. So your proceeds from insurance policy becomes 1 crore. Your premium for 5 years into 6 lakh rupees becomes 30 lakhs. So 70 lakhs is the amount that you need to treat as taxable under that income from other sources. One very important point from practice as well as academic point of view, that for life insurance policy, it is treated as income from other sources. But from a unit-linked insurance plan perspective, the income is treated under the head capital gains. And with this change, tax rate becomes very different for those under the MMR category, the maximum marginal rate category. So that's a very important aspect that you need to keep in mind. What I would also recommend, which I have not captured in my slide, but there's a circular by CBDT in case of ULIPs, wherein they have explained multiple examples to bring out the niceties under the provisions as to if a person is holding multiple policies. In that case, how can he compute the exemption available to him, and which policy he needs to treat as taxable, which policy needs to treat as exempt. This currently I'm not covering in the presentation because of the paucity of time, but I recommend you to go through that circular once. Now, I'm just taking you through this brief case study. All these are individual scenarios. So say person 1 has a unit-linked insurance plan. He took that policy on 31st Jan 2021. The annual premium is 2,60,000. So now ULIP amendment was brought in with effect from 1st February 2021. And since this policy is before 31st Jan 2021, it is not to be taxable. There's another person who has a ULIP. He took that policy on 2nd February 2021. And in this case, since his annual premium exceeds the 2,50,000 limit for ULIPs, it is taxable. In now a person 3, he has taken a policy in 31st Jan 2021, or a person 4 who has taken a policy on 2nd Feb 2021, and so on. So for up to 3 to 6, since all these policies are before 1st of April 2023, these policies will not be taxable. Now we come to the person 7 who has a life insurance plan, who took it on 2nd April 2023. The amount of premium is 2,60,000. Now again, this is not taxable because the premium is less than 5 lakh rupees. Lastly, a person 8 who has a life insurance plan, he took it on 2nd April and his premium also exceeds 5 lakh rupees. This would obviously become taxable under IFOS. So for person 2, it will become taxable under capital gains. For person 8, it will become taxable under the head income from other sources. It is very important to note that these are all individual scenarios. If one person would have taken all these policies, the answer would be dramatically different, and the answer to it is available under the CBDT circular that I mentioned earlier. Now, moving ahead. So under the Income Tax Act, there's a scheme of presumptive taxation, wherein if your turnover does not exceed a certain threshold, or your professional income does not exceed a certain threshold, you can calculate your taxes, or you can calculate your profits on a presumptive basis. So for businesses who have, turnover of up to INR 2 crore rupees, for them, it's just the 8% of turnover which is received in cash, and 6% of turnover which is received in any other mode. That is considered as your profits, and that is added to the total income. Similarly, for those who are engaged in certain professions, which I have listed down, if their gross receipts do not exceed 50 lakh rupees, straight away 50% of the gross receipts is treated as profit, which is added to the income. So for an example, if someone has an income of about 30 lakh rupees, 15 lakhs will be considered as income from PGBP, and 15 lakhs will not be taxed. Now, this particular thresholds are now proposed to be increased. So, and for the business people, the threshold is increasing from 2 crores to 3 crore rupees. But there's a condition that cash receipts in such case should not exceed 5% of the total turnover of gross receipts. For those having profession income, threshold is increasing from 50 lakh rupees to 75 lakh rupees, again with the same condition of cash receipts not exceeding 5%. They have made a clarification that any check which is other than account paying, in that case, that is equivalent to cash receipts. So if it's a bearer check, it's a bearer draft, then it is equivalent to cash receipts. They have also clarified that if any person is falling under presumptive taxation, then tax audit shall not apply in that case. So that's briefly on presumptive taxation. Now, we come to certain more benefits extended to employees. And first of which was that, so there's a TDS provision which applies whenever you withdraw balance from Provident Fund. It is taxable, the TDS rate is 10%. But for assessees who do not furnish PAN, the tax is deductible at MMR, which can go up to 42.74% under the old regime. It is now proposed that even in non-PAN cases, the tax rate, the TDS rate will be restricted to 20% instead of MMR. This is especially brought in for those because there could be some people who do not have a PAN card, or who do not, they have a very lower amount of income and they're not subject to tax as well. So just to give benefit to them, they have reduced this particular TDS requirement. Again, so in some now next provision is around residential accommodation, which employer provides to an employee. There are various rules, and so there's some provisions under the income tax rules. There's some provisions under the Income Tax Act. This was leading to a lot of confusion, and so they have now said that they will come out with the uniform rules for calculating the value of rent-free accommodation and concession. These rules are yet to be prescribed, and it will be done in due time. This again is a very important change if you have any, non-resident clients and foreign. So if non-resident clients are people who are sending money abroad for some or the other reason, there's a provision of TCS. So whenever you go to bank and ask, or go to a dealer and you tell them that you want to remit money abroad, they will collect TCS, which is then available for you at the time of filing return of income. But at first instance, that money goes out from your pocket on day 1, which may be available on day 365 when you file your return. So this TCS rates were 0.5% for education loan, For medical treatment, it was 5%. For tour package, it was 5%. In other cases, it was again 5%. Now, for education and medical, they have kept the limits as same. But for overseas tour package and any other cases, they have increased it to 20%. So this, it's becoming so probably the intention behind it is to restrict the outflow of money from India, and or to limit some outflow of some foreign funds going out of India. And that's why it's a deterrent by increasing the limit from 5% to 20%. So now if you go and you want to remit 1 lakh rupees outside India, so 20% will be withheld and only 80,000 will be the final amount that would be remitted. So that's on the LRS limits. Now this again is very relevant, maybe personally for you as well, because who is not playing online games like Rummy, Dream 11? They are the sponsors of major events, sport events that are being done in India, and a lot of interest is being generated. So there's some provisions that have been brought in for online gamings, and I'll just go through that. So winning from lottery puzzles, horse races, they are covered under 115BB and they're taxable at 30%. What they have said is that this section will not apply to online gaming. Reason for it is an introduction of a new section. This new section says that for any winnings from online gaming, the tax shall be calculated 30% on net winnings. Now, what this net winnings is something that would be prescribed later on. Whether, say, I start with 1,000 rupees, I win a particular contest, I earn 2,000 rupees. Later on, I lose another contest and I lose 1,500 rupees in that. So will my taxable income be 2,000? Will it be 500? That is something that would be prescribed in this particular rules. And we are awaiting that. They have also defined online gaming, which of course the definition you can go through. There's nothing to add over there. Similar provisions have been brought out for the TDS purposes too. I will not take more time on this so that I can cover other important aspects that are brought in. Now, while I take a sip of water, maybe you can enjoy this meal. And I also pause for a few questions if there are. Okay.
Sairam, if there are any questions, please put in front of.
Yes, sir. Yes, ma'am. Aditya Sharma was having a question, sir. Like, do you think the changes in the new tax regime have made it attractive? Like, his personal opinion was like the increase in basic exemption limit to 5 lakh only then becomes attractive.
Yeah. So I dealt with that question, and
yes,
yeah.
Like, okay. As of now, no, and students are really enjoying. Like Sejal have a comment that amazing session and really helpful. Thanks for conducting it. Thank you.
Great. Thank you, Sejal. Okay. Now we move from personal tax to corporate tax. So there's a section on benefits of perquisite. So if a person receives any benefits of perquisite from another person, whether convertible into money or not, which is arising from business or profession, that is to be taxed under section 28. TDS on such benefits of perquisites was introduced under section 194R. Now, there was a controversy on what does this whether convertible into money or not mean. So say a company has taken certain loans or borrowings and it is unable to repay those loans or borrowings. And say the bank agrees to waive, so say the borrowings was of 10 lakh rupees and the banks agree to waive off 2 lakh or 3 lakh rupees. Can that particular amount be treated as a benefit or a perquisite? So there were certain decisions or court rulings wherein it was said that since it is a transaction purely in money, it is not something that is convertible into money. It is a transaction of money. Such cannot amount to benefit or perquisite. Now, with this amendment, it is proposed to expand the section, and even any benefit or perquisite that is received in cash will also be covered by section 28 and 194R. Now, government has a very good focus on the small and medium enterprises, and what they want is they want them to grow, and they want that they realize the money from all corporates very quickly. So they have introduced this particular provision. As you know, section 43B gives a reduction of expenditure on a payment basis only. So so what they have done is that they have expanded the ambit of this particular section to cover any payments to be made to MSMEs. So say I purchase certain goods from my MSME, and I have to make that particular payment. So that invoice is say for 1 lakh rupees. I receive that invoice on say 30th of March. Now, if I don't make a payment within the deadlines, that is under the MSME Act, the deadline is 15 days, which can be contractually agreed, which can be contractually, be agreed to be up to 45 days. So, if I do not make that payment within the timelines, in that case, that particular amount will be disallowed in this particular year, and it will be allowed whenever I make the payment. So say, let's take an example of I receive an invoice on 1st of Jan. The contractually it has been agreed that I have to make a payment within 30 days. Say I do not make that payment up to 31st of March. So when I file my return, I have to disallow this particular expense. Say I make that payment on 2nd of April. Now, generally, in 43B cases, when you make a payment before the due date of filing return of income, in that case, the deduction allowed in that particular year. So the payments to SMEs, this provision is slightly different, and it says that if you do not make it till the end of, as per the contract, in that case it will be disallowed in the year, and it will be allowed only in the year in which you make the payment. So in our example, the payment will be disallowed in year 1, and it will be allowed as a deduction only in year 2. Moving on to another section, which is important from a corporate point of view, and this impact a lot of transactions or internal restructurings as well, is the case of intangibles. So for a particular, for a computation of capital gains, you need sale consideration and you need cost of acquisition. There are certain assets like goodwill, trademarks, patents, know-how, IPRs, softwares, codes, etc., for which those are self-generated over the years of doing business, and there is actually no amount of expenditure that is capitalized in the books for this particular assets. So there was a court decision in case of BC Srinivasa Shetty for the purpose of goodwill, wherein it is said that though goodwill is a capital asset, it is subject to capital gains. You have the sale consideration, but its cost of acquisition is actually unascertainable. And hence the court decided that the computation mechanism fails, and this transaction will not be charged to tax. Subsequently, after this decision, an amendment was brought in, and it was said that in case of self-generated goodwill of a business, trademark, brand name, right to manufacture, tenancy rights, stage carriage permits, or LOMARs, the cost of acquisition will be considered as nil. So this gave the computation mechanism, or this built in the computation mechanism under the Act, and hence this particular assets became taxable. Now, apart from the assets that were listed, there could be many more. So one example is IPR. So if you look at some of the judicial precedents, know-how, product information, TDR, these were not covered by the earlier definition, and courts have ruled in such cases also that the relaxation or the relief available under BC Srinivasa Shetty decision continues. So this kind of practice is what Income Tax Department wanted to stop, and hence what they have proposed is that cost of acquisition or improvement in case of intangible rights or any other asset shall be considered as nil. So now a lot of more intangible assets which are self-generated come into the ambit of this particular provision, and it becomes taxable. Now coming to the next provision around thin capitalization. So this is relevant when an Indian entity borrows from its associate enterprise any loan and on which it pays an interest of more than 1 crore rupees. So as a provision, it has been there in the act that 30% of any interest. So if say you have an EBITDA of about 10 crores and you have an interest payment of 4 crores. So EBITDA is earnings before interest, tax, depreciation and amortization. 30% of 10 crores is 3 crores and your interest is 4 crores. So this 1 crore will not be allowed to you as a deduction. These are basically the thin capitalization norms. Now this thin capitalization norms are not applicable to certain companies or certain institutions, and government has just proposed a relaxation for NBFCs. So thin capitalization norms will not be now applicable to NBFCs. I can see one question in the chat box again by Aditya. Thanks Aditya for keeping this session interactive. It's really helping. So about increasing the capex to 10 lakh crore, increasing revenue expenditure by 3%, also reducing the tax slips and income. Isn't the target contradictive in nature? So Aditya, that's a very a policy driven question, and maybe I'll not be able to comment on this in this particular topic. So maybe we can connect for this particular discussion separately. It's obviously a very interesting point, but maybe we can connect separately for this. Any other tax related questions that we have currently? Okay.
No, sir.
All right. So now I'll move on to anti-avoidance measures. So as and when government finds that people are exploiting any loopholes under the law, they introduce anti-avoidance measures so that any tax leakage is avoided. Now there's a provision around angel tax. I'll take you through the section first. So there's a section 5627B under the Income Tax Act. What it says is that if any company receives money upon issue of shares from a shareholder, till now it said from a resident. In that case, so say you have a face value of 10, you have a fair market value of that share as 100, and say investment has come in at 200 rupees. So this particular difference of 200 of the actual receipt minus the FMV of 100 is taxable under 5627B for the company who is issuing the shares. These were the provisions. There were certain relaxations available for registered startups, available for venture capital undertakings, and so on. So to these, the provisions did not apply. However, there's an interesting fact around startups that there are only about 80 to 90,000 startups which are registered in India. Remaining all startups are still unregistered. So these provisions continue to apply to them if they were taking any funding from residents. Under the current provisions or under the Finance Bill 2023, it is now proposed ambit, and this angel tax provision are going to be applicable to non-resident investors too. So even any foreign funding in a startup would be now subject to 5627B provisions. And if that funding is done at a value which is higher than the FMV, it will be taxed. So now how do you compute FMV? So income tax rules have a rule 11UA, which specifies that you can compute FMV either by adopting NAV approach or by adopting DCF approach. Now, in this current scenario, NAV and DCF approach are obviously followed in various cases, but there are many other methods of valuation too. But those are not regarded as the valuation methods prescribed under the income tax rules. Whereas when we go to FEMA, so FEMA has a provision wherein it says that any company, any Indian company which is issuing shares to non-resident investors, it can issue shares at a value which is not lower than a valuation as per internationally accepted methodology. So I'll just give you a scenario to think upon. So say as per the FEMA rules, or as per the internationally accepted methodology, the value of shares comes at 100. And as per the DCF provisions, or as per the DCF valuation, the value of the shares come at 80. So under FEMA, I cannot issue shares at a price which is lower than 100. And under the income tax, if I issue shares at a price of 100, which is higher than the FMV, I am attracting the provisions of section 56 to 7B. So this is a critical change, and we don't know as to how will this eventually happen in commercial deals, and we are awaiting clarity from the department on this aspect as to whether a valuation under FEMA will be accepted under income tax provisions or not. So this is something that we need to look out, and we may, the department may also want to clarify on this particular aspect. Coming to the next provision around gifts to RNOR. So what happens is, if you give any sum of, if a resident gives any sum of money to a non-resident, a view was possible under section 5 and section 9 that this particular money, if the situs of this money is outside India, then it is not subject to tax. So few years back, government decided to plug out this loophole, and they said that if a resident receives money from, if a non-resident receives money from a resident exceeding 50,000 rupees, that will be deemed to accrue or arise in India. Now, what they observed is that even in cases of not ordinary residents, this view is being taken, and hence they have expanded the scope and said that any sum of money received by not ordinary residents from residents on or after 1st April 2023 will again be treated as taxable in India, or will again be treated as an income deemed to accrue or arise in India. So this is under domestic law. We have to be mindful of the fact that even treaty provisions could apply in this case, and so we need to effectively look at the treaty provisions as well, and then come out at the taxability of it. Not ordinary resident, I have defined over here. Maybe you can just go through that definition once I share the slides with you. Now coming to the next concept of a joint development agreement. So you would be aware that, say I hold a property and it's quite old. A builder might approach me. They could tell me that that they'll purchase this particular property, they'll build a building, and in that building they will give me 2 or 3 flats. So that's typically a joint development agreement. Now, how do you compute a sale consideration in such cases? So section 45(5)(a) provides us that guidance, that whenever an individual or HUF transfers a land or a building or both under a joint development agreement, then that particular transaction will be subject to tax. And for computing sale consideration, you have to take the stamp duty value of the immovable property along with consideration received in cash, and that amount will be regarded as your sale consideration, and then you compute your capital gains therefrom. So people were taking a quite aggressive position that since the section mentions consideration received in cash, any amount that they received by way of check or by way of ECS or by way of electronic mode, that is not to be added to the sale consideration. And now that plug hole is being again, they're taking care of it by substituting consideration received in cash by consideration received in cash or by a check or a draft or by any other electronic mode. So that's an amendment to rationalize the provisions around 45(5) and to make it line in with the intent of the government. Just a quick fact, maybe I thought you'll find this interesting to note how the slab rates have changed over the years. So just for that purpose, I'll also pause for any questions on the slides that I've dealt with till now. Yeah. So if there are no questions, I'll move ahead with the presentation. There are about 15 minutes left for me, so I'll just try to cover up as much as we can. So we have dealt with personal tax, corporate tax, anti-avoidance measures, and now we move on to the various tax incentives that have been introduced by the budget. So under the Act, there's a provision under Section 79, which says that if a company which has incurred losses and subsequently when it starts to earn profit and it wants to set off those losses, in both these years, the shareholding should not change by more than 51%. These provisions are not applicable to startups in the first 7 years of incorporation, after incorporation. Or in fact, they are available for losses incurred by startups in the first 7 years of after incorporation. But there's one condition which says that all shareholders must continue. So basically, there's a startup with 2 co-founders, 50-50% each. Now, over the period, if they bring in more angel investors, more VC funds to the cap table, and ultimately they don't sell off any of their share, but their shareholding is reduced because of such infusions to say 10%. From 100%, it goes down to 10%. In such cases, they say that for startups, the losses shall not lapse and it shall be available. Now they have brought in a relaxation and they have proposed that the 7 years limit will now be in line with the deduction that is available for them under 80 ISC, and it will be increased to 10 years. There's and as I mentioned, now coming to that particular deduction under 80 ISC. So very briefly, 80 ISC deduction says that a startup can consider 100% of its profits as exempt for any 3 consecutive years out of 10 years from the date of incorporation. There's a condition around that the startup shall be incorporated on or after 1st April 2016, but before 1st April 2023. It is proposed to extend that the sunset date be 1st April 2024. So you now have additional 1 year to come up with an idea and to start your own business, so that you can take benefit of this particular tax incentive of 100% of the profits. IFSC is a new concept, not new concept, but a very interesting and important concept. It's situated in GIFT City, Gandhinagar, and a lot of benefits are available for the entities that are there. So one of which is, so say there's a fund which was established outside India, and that fund is being brought back to IFSC. There's a capital gains related exemption for such funds. There's also some income exemption for income distributed to non-resident offshore derivative instrument holders by the IFSC banking unit. That particular income is also being considered as exempt now under section 10(4)(e). Yeah. Now, charities again is a very important concept, and a lot of changes are being made in this particular area too. And in last 3-4 years, we have observed a lot of amendments, a lot of strict restrictions that are being brought into charities. And this year again, there were quite a few important amendments. We'll just go through the most important ones. So, say there are 3 charities. What was possible earlier is that one charity receives donation of 100 rupees for someone. It passes on that 100 it passes on 85 out of that 100 to another charity. In that case, the exemption would be available to the first trust because it is applying 85% of its income by way of a donation to another trust. The trust too would then, it would then 85% of 85, whatever that amount comes, it donates it to trust 3. So, and it would again then have an exemption available under the income tax provisions. So this, by doing this, maybe there were some institutions who were not, utilizing the proceeds effectively, but not utilizing for the benefit of public at large, but rotating amongst various trusts. So to plug this loophole, the amendment that has been brought in, that is when you donate, when trust 1 donates to trust 2, only 85% of the amount donated will be considered as application. We'll try to decode this by way of an example. So say there's trust one, it receives a voluntary contribution of 500 rupees. It donates an amount of 200 rupees to another trust and it spends on charitable activities of 150 rupees. So 500 minus 200 minus 150, that the surplus that remains with the trust one is 150. Now, earlier what provisions said is that if you utilize 85% of the contributions received, then you are treated as an exempt charitable trust. So voluntary contribution was 500, 85% of which comes to 425. So we would test that whether 425 has been spent. In this case, earlier the actual spend was considered as 200 plus 150, which is 350. So 75 rupees is the amount which is considered to be not spent. Now, if the trust accumulates this particular amount, again, the exemption was available. So we consider that trust one has to accumulate 75. Now, what is proposed? Again, the voluntary contribution amount donated on other application remains the same. Of course, the minimum application also remains the same. What changes is what is considered as the deemed or actual application. So for this 150, the entire would be added. For this 200, you have to calculate 85% of 200. And 85% of 200 plus 150 comes to 320. So this is the amount that is considered as applied by the trust. And hence amount to be accumulated by the trust in this case turns out to be 105 rupees. We take another example. So this trust has received voluntary contribution of 50. It has received donation from other trust of 200 rupees. It has received, it has donated to another trust at amount of 200 rupees, and it has another application of 35. Surplus is 15. Now, minimum application in this case would be the donation that is received. It has received from other trust, which is 200, plus the voluntary contribution, which is 250. So 85% of 250 comes to 212.5. Actual implementation or actual application or deemed application in this case would be 85% of 200, which it has donated to the second trust, plus 35 rupees of actual application. That comes to 230. That comes to 205. Earlier, it would be the entire 200 plus 35, so 235 rupees. So 235 and 205, that's the difference. So in the earlier scenario, the amount to be accumulated would be 0. In the proposed scenario, the amount to be accumulated would be 7.5. So this was another important amendment that has been brought in. I will now come to the compliance related changes. So there's a form 10, form 9 that is to be filed. And this was to be filed earlier before the due date for filing return of income. Now it has been proposed to file this at least 2 months prior to the due date. Also, they have brought in a provision which is very critical, that if a charitable institution does not file its return within the timelines of within the due date of filing return of income under 139(1), in that case, they will not be allowed to take the benefit of exemption. There's a concept of provisional registration and final registration that is available, that is there existing in the case of institution. So earlier it was like, first you apply for a provisional registration before the beginning of the financial year. And once you begin your activities, commence your activities, then you apply for final registration. There's a clarification brought in which says that if activities have commenced already, then you can directly apply for the final registration. You need not go for the provisional registration. They have widened the scope to cancel the registration of charitable activities if there are any violations that are there, and they have expanded the scope of such violations. Now we come to the next topic of assessment and appeals. I'm mindful of the time. I've just 10 minutes left, so I will quickly run through the assessment and appeal related provisions or the key amendments that are brought in. So there are some changes in the timelines, normal assessments assessments in case of updated returns and cases where search or acquisition is pending. So this timelines are proposed to be extended. There's an increase from 9 months to 12 months in normal assessment case and in cases of updated return. In case of search or acquisition, it is increased by additional 12 months. So this is just a chart for you to note that for AY 21-22, normal assessment timelines is 31st December and TP assessment is 31st December 23. For AY 22-23, normal assessment is due by 31st March 24, TP assessment by 31st March 25. And similarly for AY 23-24, it's the 1 year after that. Yeah, this again is an important change. So as you are aware, you can claim a TDS credit under return of income if you're offering income of that particular year in the very same year. So there could be cases where income, I follow a mercantile system and the person from whom I'm receiving income follows cash system or vice versa. So there could be various changes, and because of which it may be a scenario wherein income is received by me in year 1, TDS is received, TDS is deducted in year 2, or something of that sort. So for such changes, or to enable claim of subsequent TDS, so say I offer the income in year 1, but the deductor deducts income in say year 2 or year 3. In that case, if my revised return timelines are not available to me and they have lapsed, in that case, how do I claim a credit for TDS? So now they've introduced a mechanism wherein I can make an application to the AO seeking the credit of tax. The time limit for making such application would be 2 years from the end of financial year in which TDS was made. So say year 1 is when I offer my income, year 4 is when the TDS is deducted. So I have time till year 6 for making that claim before the AO. So that's the critical change and a critical flexibility that has now been introduced. There's some clarification around interest for updated return, which maybe we can skip. And yeah, so since I have some time left, I will take you through the miscellaneous incomes as well, or the miscellaneous amendments to some of them. So over here also, I have arranged it as the same Saptarishis that were identified earlier: personal income tax, corporate tax, anti-avoidance, and so on. So again, switching back to the personal income tax. So there's a concept of market-linked debentures. This market-linked debentures are, they are a kind of a debt plus derivative instrument, and they are classified by SEBI. So earlier a view was possible that since these are listed instruments, the long-term capital gains on these instruments should be taxable at 10% without indexation. Now the provisions have been tightened on this aspect, and it is said that any sale consideration received on transfer or redemption of market-linked debentures will be treated as short-term capital gains, and it will be computed after reducing the cost of acquisition and expenditures. So now the tax rate would increase from 10% to maybe 39%, maybe 42.74% in some cases. There was, so as you know, TDS provisions are applicable on various incomes. It is applicable on interest also, but the TDS on interest on listed securities was earlier not applicable. Now it is proposed to remove this relaxation, and even interest on listed securities will be subject to TDS. So now coming to the next, another amendment, which is for corporate taxes related in business reorganization cases. So business reorganization essentially would mean merger, demerger, IBC cases. What happens is that companies decide to go for a merger. Say in year 1, they file a petition with NCLT. It takes time for NCLT to process the entire application and to finally allow or disallow the merger. And by the time the merger is allowed, all the compliances are being done by both the entities that are getting merged separately on their own account. But once the merger is effective, both the entities are combined and they are considered as one. So the provisions now allow that the successor can file a modified return after receiving the order from NCLT, and the assessing officer can now consider such modified return in the course of assessment or reassessment. I will take this one more slide and then I'll pause for questions if there are any. So again, there are some TDS and TCS reliefs. In case of units of mutual fund, if there are any payments made to non-resident, such payments are subject to a tax deduction of 20%. But in certain tax cities, there could be a lower tax rate available. So it is now, and earlier such lower tax rate was not possible to be considered while deducting TDS. It is now amended and it is now proposed that such lower tax rate available under the treaty can be considered. Scope for, so 194 LBA is a interest provision on certain specific instruments from which you earn interest, and the scope of that section is now covered under section 197 also. So 197 is the section for lower withholding certificates, and so person who are receiving incomes under section 194 LBA can also now apply for a lower withholding certificate. That's the broad change. So certain non-residents were subject to TDS and TCS rates under section 206 AB and 206 CCA if they were not filing return of income. Now what has been specified is that any non-resident who is not required to file income tax return will not be subject to such higher TDS and TCS. This is a welcome move, and this would ease down the burden from non-residents who are actually not required to file return of income. And in such cases, if they were not filing, they were subject to higher tax. So this is a very welcome move and a relief for such non-residents. I think I will now pause for any questions. Remaining slides are again around such miscellaneous amendments that have been brought in, and maybe you can go through those provisions.
Thank you, sir. It was indeed, it can be seen complete presentation that you were very eager enough to share more and more knowledge to all our dear students and for more new concepts and more clarity to the budget 2023. Yes, we are waiting for question and answers for next 2 to 3 minutes. If anyone, please post it.
Chirag sir, there were some queries over YouTube.
Yeah.
I don't know whether they were posted in the beginning or middle or during the end, but let's try to answer those queries.
Sure.
Those are posted by Sumit Jain.
Okay.
10,000 का जो deduction है for professional tax, is it allowed in new regime?
Sorry, which one? Can you repeat, please?
2,500 rupees deduction for professional tax.
Okay.
Is it allowed in new regime?
No, it's not.
Okay. So what is the MMR? I think maximum marginal rate क्या है?
Okay, so maximum marginal rate would be 30% of your base rate plus the maximum surcharge, which is 37%, increased by cess. So that comes to 42.74%.
Okay, thank you. And last query, can an employee take deduction for pension in new scheme if he contributes on its own?
Under the new scheme, yes, 80 CCD 2, if you're making contribution, you can take a deduction up to 50,000 rupees.
Okay, sir. That's all from my side.
Great. Okay. And thank you everyone for listening patiently. It was quite a long session on a Friday morning, and you already have your busy schedules ahead. So thank you for listening and joining.
Yes, sir. Moving ahead, as of now, there are no questions from the students' end, and surely you will be connecting with them personally also if there are any questions.
Great. Yeah.
Yes, sir. We will even share the slides on our official channels on our website. And now to propose a vote of thanks, I request Honorable Chairman Satara Vikasa, CA Rushikesh Wangde sir, to present the vote of thanks.
Thank you, Sairam. First of all, we are really grateful to Pune ICA, WRC Vikasa, and Anand Vikasa for joining this and taking this very fantastic initiative. And this session was really interesting and both required था. बजट सेशन के जो DT and IIT में चेंजेस थे उस पे सेशन लाने के लिए आई एम रियली ग्रेटफुल टू मौसमी मैम फॉर डूइंग दिस फैंटास्टिक सेशन. देयर वाज वन सजेशन बाय केतन सैया सर आल्सो. हम DT IIT पे तो बहुत सारे बातें करते हैं, डिस्कशन करते हैं, उस पे लर्निंग करते हैं, लेकिन बीइंग अ चार्टर्ड अकाउंटेंट आवर गोल इज नॉट only restricted to DT and IIT. We can also contribute much more to the economy as a whole. So DT and IIT के साथ साथ भी बाकी के जो एस्पेक्ट्स है उस पे भी अगर आप कवरेज कर लेंगे, बजट में क्या है, उसमें इकोनॉमी के लिए क्या क्या रिलेटेड है, तो इट विल बी मोर बेनिफिशियल. एंड यहाँ से आगे जाके जो भी हम ऐसे बजट के सेशन रखेंगे उसमें आई विल ट्राई कि एक छोटा सा सेशन, इफ नॉट दैट मच प्रोमिनेंट, एटलीस्ट थोड़ा बहुत तो सेशन में इकोनॉमिक के जो अमेंडमेंट्स है उस पे भी अगर हम फोकस कर पाएंगे तो इट विल बी रियली ग्रेटफुल, रियली वंडरफुल. कमिंग बैक टू चिराग सर ने तो बहुत अच्छी तरीके से DT के जो सारे अमेंडमेंट्स है वो कवर अप किए हैं. एंड इट वाज रियली, मतलब आई वाज वाचिंग ओवर यूट्यूब एंड आई वाज फीलिंग दैट कि जो सारी चीजें कवर अप होनी चाहिए थी वो सारी कवर अप हो गई. एंड इट वाज रियली फैंटास्टिक. एंड देयर वर सम क्वेरीज आल्सो इन बिटवीन, एंड उसको भी चिराग सर ने बहुत ही अच्छी तरीके से हैंडल किया है. एंड आई नो कि DT के अमेंडमेंट्स बहुत सारे वास्ट थे, तो it was not that much easy to cover up during this limited time, but he definitely successfully tackled it and tried to cover many important amendments during this short 1.5 hour time limit. So thank you, Chirag sir, for accepting our invitation and sparing his valuable time on this Friday morning. So once again, thank you Mosmi ma'am, thank you Ketan Samdani sir, chairperson of Anand Vikasa, हमारे केतन सैया सर WRC विकासा के चेयरपर्सन, एंड हमारे पूरी स्टूडेंट की टीम इंक्लूडिंग सायराम फॉर organizing this fantastic event. That's all from my side. And before going to conclusion, I take this really glad opportunity to congratulate Pune Vikasa, entire team Pune Vikasa, for bagging first prize at national level and getting best students association award. It is really prestigious and normally actually it is ट्रेंड है कि पुणे विकासा को प्राइज मिलता ही है, लेकिन इस टाइम जो मैम ने एफर्ट्स डाले थे एंड वो सारे दैट मैंने बहुत क्लोजली वो देखे हैं, तो वो थोड़ा सा और भी अच्छा लगता है कि यस दैट प्राइज शुड हैव बीन एंड पुणे विकासा ट्रूली डिजर्व्ड एंड इट वाज एंटायर टीम एफर्ट्स. थैंक यू वेरी मच. मेरे आई एम शॉर्ट ऑफ वर्ड्स, सो आई एम स्टॉपिंग राइट नाउ हियर. ओवर टू MSc for the further proceedings. Thank you.
Thank you so much. Thank you so much, Rushikesh sir. Thanks for your kind words. Before I hand over to the MOC, I would also like to thank Chirag sir for just a wonderful session that he has taken today. And Chirag sir, I also know that you are a M&A expert, and soon we would like to have a session on that topic as well for our students. Our students will definitely benefit from this topic. So I hope you would agree on taking a session on M&A as well soon.
Yeah, thank you first of all for calling me an expert. I'm actually learning, and I'm in process to becoming an expert firstly, but thank you for that, and I will be very glad to take any session on M&A. I will be very happy to do that. So whenever you say, we can plan that.
Thanks. And thank you WRC Ketan Saiya sir, and also Ketan Samdani sir and Rishikesh Wangde sir for joining here. And thanks a lot, Sairam also. Sairam, over to you. You may close the session now.
Yes, ma'am. Thank you everyone for joining the session. Thanks to the audience and thanks to all the panel members present here. We keep the closing remarks from all the faculties here present. Thank you, Rishikesh sir. Thank you, Mosmi ma'am. Thank you, Chirag sir. And yes, thereby we conclude.